Have you ever seen the stock market shoot up for no clear reason or crash overnight even when nothing big happened? That's not magic. It's market sentiment. In this video, I'll explain what market sentiment really is, why it behaves a lot like human emotions, and how understanding it can make you a calmer and smarter investor. Part 1. What is market sentiment? The stock market isn't just numbers on a screen. It's people. Millions of investors making decisions every second. Market sentiment is simply the overall mood of those investors. When people feel confident, prices rise. When they feel worried or uncertain, prices fall. That's why breaking news, earnings reports, or even a single viral tweet can move markets up or down in minutes. Think of market sentiment like the weather. Sometimes it's sunny and warm optimism everywhere. Other times it's stormy and cold fear takes over. You can't control the weather, but you can definitely prepare for it. Part 2. Is market sentiment like human sentiment? Yes, because it's built entirely from human emotions. Two feelings dominate markets: greed and fear. Greed pushes prices higher than they deserve to be. Fear drags prices lower than they should go. And then there's herd mentality. Just like a crowd at a concert, if one person runs for the exit, everyone else starts running too, even if nothing's wrong. In markets, when everyone's buying, you feel like you're missing out. And when everyone's selling, you feel like you need to sell too. The good news? Unlike your emotions, market sentiment can be tracked. Tools like the Volatility Index or VIX, investor surveys, and unusual trading spikes help us see when investors are unusually fearful or overly confident. Part 3. Why understanding sentiment helps. If you understand how sentiment drives short-term prices, you won't panic when markets dip, and you won't get carried away when prices rise too fast. Smart investors even use sentiment as a signal. When everyone's euphoric, they step back and stay cautious. When everyone's terrified, they see buying opportunities. As Warren Buffett famously said, "Be fearful when others are greedy, and greedy when others are fearful." Knowing how sentiment works helps you avoid emotional investing. You stop chasing hype and start thinking long-term. Part 4. How to stay rational. So how do you keep a cool head? First, focus on the fundamentals of the companies you invest in, not the daily headlines. Second, diversify your portfolio so you're not betting everything on one stock or one sector. Third, set clear investing rules for yourself before emotions hit. Decide how much you'll invest each month and stick to it. Decide when to rebalance and follow through. Remember this, market sentiment moves prices in the short term, but real value always wins in the long term. Market sentiment is powerful, but only if you let it control you. Understand it, respect it, but don't follow the crowd blindly. In the next episode, we'll talk about how to pick your first stocks and avoid common beginner mistakes. If you're ready to build smarter wealth, make sure to like this video, subscribe, and share it with someone who's just getting started. This is Fortunes Forward, helping you invest with confidence, one step at a time.